Hello, investors and future investors. Welcome back to the channel. My name is Tim, and on this channel, I'll show you how I use my portfolio in order to generate weekly income. For today's video, I will be showing you one option strategy that I use on a consistent basis in order to keep growing my portfolio weekly. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. Now, like I mentioned, this option strategy is one that I use on a consistent basis in order to keep growing my portfolio weekly. This option strategy has been tried and tested by investment bankers and huge institutions, and the result is always the same: consistent revenue on a regular basis. So we're going to stick to the strategy of this channel, in which we're going to give you a complete walkthrough of how this strategy is to be done so you can follow along with us. And there's only one way to really learn options, and that is to get down and dirty with options. That being said, for today's video, we're going to be using Marathon Digital, ticker MARA. Okay, so here we are on Mara Holdings. And before we get into that, I want to remind you guys, always do your own due diligence before getting into any trade. Also, before getting into any trade, always make sure you have an exit strategy. So let's go ahead and get started. So now we're going to go ahead to trade Mara options to the bottom right. And what that's going to do is that's going to open up the options chain. The option chain is something that allows us to make a more informed decision. Now, for this option strategy, we're going to first make sure it says sell and call, and then we're going to go now and choose our strike date. Now, I do sell weekly options, but feel free to choose any strike date that suits your personal preference. For this video, I'm going to be going with September 20th. Now, with this option strategy, I'm going to go ahead now and I'm going to choose my strike price above the current share price. Now, as you can see here, the current share price is trading at 15.84. So I'm going to choose a price above that. Now, I will be going with the 17.5 strike price. As you can see, strike price up here. Now, with the 17.5 strike price, that's going to give me a chance of profitability of 83%. Okay, so with a strike price of 17.5 and a chance of profitability of around 83%, that's going to allow me to make 0.26, or in option terms, that's going to be equal to $26. Each option contract is multiplied by 100 shares. We're going to go ahead, we're going to click into it, and there the strategy is going to be revealed. Now, this strategy is none other than the covered call strategy. Now, as simple as this strategy looks, there are a few caveats which we're going to go over right now. So let's go ahead to continue, and we're going to stop right here for now while I explain this trade to you. So, as simple as the strategy is, I'm going to show you how my decision making and why I came up with the 17.5 strike price as opposed to any other strike price. Now, in order to get that, you need a bit of experience and you also need to learn the Greeks. So, in order for you to get into the Greeks, you first need to click into whatever strike price you are, and this is going to open up. And this area here is known as the Greeks. So, with my strategy of investing, I usually go on a chance of profitability. However, some traders use what we call delta. So with that 83% chance of profitability, that's also going to be equal to a 23 delta. It's pretty much the same thing. Feel free to choose whichever one works for you, whether the delta works for you or a chance of profitability. Now, one thing I would like to note, and I did say to please use your own due diligence, is that this stock that I'm using for this video is extremely volatile, and that's why I am using it. Because the more volatile the stock is, the more money you make. However, the volatility is real, and you need to be careful how you trade these stocks. So as you can see here, the implied volatility for Mara is 92%, which is extremely high. However, look at the open interest. The open interest is seriously high. So that tells me I'm not the only person that loves trading this stock. Okay, so let's get out of the option Greeks. So now we're going to go ahead and we're going to explain how you win this trade or how you not so win this trade. This trade, in my mind, I call this trade a win-win option strategy, and I'll go ahead and show you why it's a win-win strategy. Right before we do that, if you guys are getting any value from this video, feel free to like the video, subscribe to the channel, and most importantly, hit that notification bell to get an alert when I post a video. And if you guys are struggling with options, and you need to make revenue on options, go ahead and choose the first link in the description below. Maybe we can help. Okay, so now that we've implemented the covered call strategy, the next step would be is that we need to choose the amount of contracts. And I do have 200 shares, but I will go ahead and choose two. The one difference between doing a covered call strategy with a small account and doing the exact same strategy with a big account is your amount of capital you have in your account, which is going to allow you to scale. So for instance, I do have 200 shares in my account. So if I were to do two contracts, I would be receiving around $50 per trade. However, if someone, a big institution, were to do this and they were to put 12 contracts, then they would be making around $300. The strategy remains the same. The strategy remains sound. The difference is your portfolio size. Okay, so how does this trade go come expiration date? Well, the trade could go either of two ways. But most importantly, in order for you to do the covered call option strategy, you must own 100 shares or more. Okay, come expiration date of September 20th, there's two ways in which this trade can go. If at expiration date, Mara is trading at any price below our chosen strike price, which is going to be the 17.5, then we get to keep our premium and we get to do this trade again for the following week because now our collateral of our 200 shares will be released back to us. So you get to continue making regular premium. And that's how I was able to grow my account on a weekly basis. Now, the other way this strategy could go is that come expiration date one more time, if Mara is trading for any price above the 17.5, then once again, you get to keep your premium, which is going to allow you to keep growing your portfolio. But now you're forced to sell 200 shares, which is not a bad thing. So now you're going to lose your 200 shares. However, you're going to be able to keep your $50, and then you're also going to make an additional income in which we call capital gains. So the capital gains on this is going to be the price you bought Mara initially minus the price you're selling it. So for instance, let's say you did buy Mara at $16 and now you're forced to sell it at 17.5. Well, now you would have a capital gain of $1.50, which is 16 from 17.5, and then you multiply that by 100 shares. So you will get an additional gain of $150. So $150 plus $50 premium that you received, and that's $200 in just 1 week. And this is how simply and consistently you could grow your portfolio using this simple option strategy known as the covered call option strategy. Okay, so for those of you that have made it this far, I'm going to show you one other stock that I have in my portfolio in which I used to make weekly income, and that's going to be Lee, ticker LI. Okay, so Lee is a better stock if you're new to option trading because its volatility is way better than Mara. So let's go ahead again so we could practice your strategy. So we're going to go ahead to trade Lee options, wait for the option change to open. We're going to go ahead and make sure we sell and call. And then now we're going to choose our expiration date one more time. And since I'm doing weekly options, I'm going to go with September 20th. I'm going to proceed now to choose my strike price above the current share price. And I will be going with the $20 strike price. Let's go ahead and click into that. And now I'm going to open up the option chain so you can see the difference between Lee options and also Mara. Okay, so here we are on the Lee options chain, and as you can see, the chance of profitability here is going to be around 80%. However, look at the implied volatility compared to that of Mara. 56%, or let's round out 57% implied volatility as opposed to Mara, which showed us a 92%. So that is the difference right there. If you are new to option trading, please choose a stock where the implied volatility is a lot lower. That's going to help you with being more consistent. So let's go ahead. We're going to finish up the trade. And for this trade, I'm going to be getting 0.20 or $20. We're going to go ahead. We're going to hit continue. We're going to choose one contract. And voila, once again, you're now able to make weekly premium once again on a different stock. So that right there, ladies and gentlemen, is known as the covered call strategy. The covered call strategy is a win-win option strategy in which anyone could use, whether you're new to trading or you're being a seasoned trader. This strategy can be used in order to grow your portfolio steadily, consistently, and also safely. Thanks for watching. Remember, hit the subscribe button in order to be part of the weekly income team. and share the video with someone you think can benefit from its content. And also, if you want to be part of the weekly income team, remember, check out the first link in the description below. And until next time, keep pushing your investments. Now, right before you go, there should be two videos appearing anytime now. Feel free to go ahead and click any one of them. I strongly believe that they're going to help you continue your knowledge in option trading and help you to become part of the weekly income team.